Let's get to the market action now. Bob Iaccino, co-founder and chief market strategist at Path Trading Partners. Bob, what are your three trading keys and what seems to be the fallout from Friday's report showing low hiring, which many people were thinking could push the Fed to cut rates, and then the president now talking and firing the commissioner?
Well, number one, I'd say the reaction to the non-farm payrolls number last week. We saw sort of an exit of most of that reaction in Monday's trade. We saw a little bit of a rally in the equity markets, and I think that's probably the right way to go, because with that weaker non-farm payrolls number, taking Trump's bad optics of firing the head of the BLS aside, we're looking at a number that is probably not where it's going to stay. I don't think the deceleration is going to continue. So the market's reaction to that on Monday, I think, was correct. Then you saw also on Monday, the EU come through and cancel their reciprocal tariffs, which was sort of a procedural thing that they needed to do in order to confirm that the deal announced by van der Leyen and Trump on the 27th of July was actually a real deal. It was a procedural step they needed to take. So I look at those two things, as one thing. The second thing I'd look at is the easing in crude oil prices that we seem to be getting after that initial spike we saw last week. And that has to do with OPEC Plus on Sunday night, confirming again that they were going to continue to increase production, 2.2 million extra barrels a day. And that's going to be something that eases inflation that some people are still worried about with the effects of the tariffs. So if you see crude oil prices weaken, which we're starting to see again from that recent spike, then that's going to ease the pressure of inflation and again, clear room for the Fed to cut rates as well.
How about your trade of the day, Bob?
Well, I'll tell you what, I can tell you one that I'm long, and I can tell you one that I just recently bought. Early Monday, I bought MAGS, which is the MAGS 7 ETF from Roundtree. That particular ETF covers all seven of the MAGS 7. They're all just flat out included and blended into one product. And I like that because you don't have to take the individual risk of the seven. You know, they're named after the movie Magnificent Seven, and 4 of those characters died. So I worry about, putting too much money into any one of the MAGS 7. So I like that ETF. I also own and I'm holding Target. And the reason is we are seeing wage increases. And Target took a hit as a stock because they did away with their price matching. But now you're seeing them doing individual sales to kind of keep the traffic in the stores. And I think that's going to cause the stock to rebound. They have a dividend on August 13th, and they got earnings, I believe, on August 20th. So I may exit that trade if the earnings or the guidance is poor. But those are two I like right now. And I like, again, Target on that downdraft that it got, but I owned it during that. So it's kind of talking my book. And again, the Magnificent Seven as a whole, because I don't feel good enough in technology to be able to pick out which ones are good and which ones are bad in the MAGS 7.
Always a pleasure to have you here. Thank you, Bob.
Good to see you again.